Amongst numerous business scandals, represent by far the largest fraud in American history, Enron Corporation and Arthur Andersen. The cases break down into an overview of Enron until its bankruptcy, followed by issues, impacts on the accounting system, and recommendable solutions to the case. Established in 1985, Enron was a U.S. energy trading and utility company based in Houston, Texas. After the SEC approved the mark-to-market accounting for Enron, the CEO of Enron hid financial losses to have a profitable appearance. In the year 2000, Enron was valued at $70 billion, which did not last long. Enron's activities were eventually caught by the SEC, and soon after Enron's all-time high, Enron announced $638 million in third-quarter losses, $1.2 billion reduction in equity, followed by a $690 million obligation that could come due on November. Consequently, Enron's share per value plunged below $1 and led to bankruptcy.
So what has actually happened to Enron? Enron created hundreds of SPEs, among which was Raptor, Talon, and others, and used them for creating fake revenues and hiding company losses. For example, Enron would take underperforming assets from its financial statements to the financial statements of those entities, or use SPEs to raise funds without being required to report the debt in its balance sheet. How? Enron was purchasing assets with loans from the SPE collateralized by Enron common stock. Many of Enron's SPE transactions resulted in the company's profit being inflated by unrealized gains on increases in the market value of its own common stock. Enron would sell assets at inflated prices to the SPEs and record large gains on those transactions. Moreover, Enron abused the SEC-approved mark-to-market accounting, taking advantage of it to inflate its profits. According to the MTM, energy traders must book all the projected profits from a contract in the quarter when the deal is made. However, some of Enron's contracts extended over periods of more than 20 years, and Enron's officials took advantage of that and purposely made assumptions that reflected inflated profits to enhance the image of its financial performance. But what was the role of the Andersen firm in this fraud? One issue with Andersen is that it provided more than auditing services to Enron, including consultancy, for which it has been paid over $25 million in fees. Andersen was deeply involved in some of Enron's largest and most questionable SPE transactions. Its auditors approved various disclosures, even though the disclosures were unclear and failed to convey what was actually going on. Andersen didn't fulfill its duty to point out the questionable transactions and refrain from giving an unqualified report, but instead, it helped Enron to structure the SPEs and even draft disclosures for those transactions. When Enron's fraud surfaced, Andersen tried to shred the reports regarding Enron's SPEs, which only confirms their implication in this fraud.
Now let's look into the positive impacts on the accounting system after the Enron scandal. The FASB imposed stricter accounting and financial reporting guidelines on SPEs as a direct result of the Enron case. The new rules required companies to include the financial data of SPEs in the consolidated financial statements of parent holding. In 2002, Congress passed the Sarbanes-Oxley Act to strengthen financial reporting for public limited companies. By improving the rigor and quality independent audits, it limits the type of consulting services that independent auditors can provide to their clients and requires public companies to prepare annual reports on the quality of their internal controls. We really are starting to see much better audits performed than what we used to see. Errors in the books get caught much quicker. More active, clearer delegation of responsibilities of who is doing the oversight. With respect to the audit firms, even though the SEC has the main authority, the Public Companies Accounting Oversight Board has taken a more active role in enforcing regulations and protecting the audit firms. The investor safeguards, especially private account utilization. Expansion of some retirement programs that have been put in place are impacting everyone today. Investor can get better stock information and better stock prices. After analyzing and understanding the case, we believe these followings are recommendations that auditors and clients' firms should adopt. Firstly, firms should prohibit the provision of all non-audit services to audit clients. Firm should require that audit clients periodically rotate or change their independent audit firms. Last but not least, firms should establish statutory requirements for independent auditors to work more closely with clients' audit committee. By doing these three recommendations, it would help both auditors and companies to improve the efficiency and prohibit similar scandals to recur again. In addition to our recommendation, as a governmental solution, a new federal agency called the Public Company Accounting Oversight Board was created. This had made an immense impact on the overseeing of the rulemaking process for the independent audit function.